Hello, I'm MaryAnn, and I'm here today with Eric Sappenfield, Managing Director, Epic Investment Partners, and we're talking about the 9% solution. Now, this is the solution that underlies the global shareholder strategy that they have. So just to start off and make sure we're all on the same page, this is an aspirational 9%, am I right?
That's right, MaryAnn. It's a 4.5% cash dividend, another 1.5% in share buybacks and debt reduction, and a 3% growth rate to the operating cash flow of the fund.
So how do you actually sum that all up? It must be a lot of work that goes behind getting those numbers.
It actually is quite easy. Every Monday morning we run a proprietary screen that allows us to search the global universe, 14,000 or more stocks, for companies that have a history of paying a reasonably high dividend, a consistent dividend paid from operating cash flow, a management team that's committed to that dividend, and one for which the stocks are liquid in the marketplace. We've done this every week since 2005 when we launched the initial strategy, and we've produced very good returns from this disciplined process.
Is there also a fundamental bottom-up part to it?
Absolutely. Once we've screened the stocks, we look at them, we make sure that the information in the database was correct, and then we could have put on a couple of years worth of projections to see that the companies not only did it in the past, but are going to do it again in the future.
So what kind of metrics would you look at, for example?
Obviously, we look at the high cash dividend. And what we're looking for is not the highest cash dividends, but those companies that have a strong 3, 4, 5% cash dividend, but the ability also to grow it. So they're not paying out all of their earnings in the dividend. We look for a cash flow growth rate. We look for a management team that can make its company competitive within an industry.
So do you find your examples of companies in the U.S., globally, everywhere?
As the fund is titled, it's global. And we find them in companies like Dow Chemical or in Vodafone. So they really are all over the world.
So let's look at your examples then. Dow Chemical. Start off with that one. How does that fit into the big picture?
So Dow Chemical is a company that produces intermediate chemicals for industrial production, housing, automobiles. And as the U.S. economy has gotten to be stronger, we have more confidence in their ability to continue to pay their 3.5% cash dividend, as well as buy back shares and reduce debt. So as we look at this company and we say, things are getting better, companies delivering more cash, we found a place for it in the portfolio.
Now, does it change over time depending on where the company is in the cycle as to how much they pay out?
It can. So in European companies, they have what's called a progressive dividend policy, where rather than the absolute pennies per share that they pay out a certain percentage of their profitability.
And let's try your next example, Vodafone.
So Vodafone's the global mobile telecommunications company. They're currently in the news for selling their stake in Verizon Wireless, the U.S. wireless company. But more importantly, post the sale of Verizon Wireless, they're going to have operations in Germany, the UK, Spain, the Caribbean, India. They're going to generate enough cash flow to pay a 5.5% cash dividend going forward on the stub company. So that's the reason for investing in this business. Strong cash flows, growing cash flows, and a significant return to the shareholder.
So do you worry at all when they come out with these mergers, acquisitions, that's going to change or the strategy of the company? What do you do then?
Absolutely. We take it apart. We look at it. We see how does the business combination fit with what management has told us in the past and what we think it'll do to the future.
So any type of sectors that you find are more attractive than others?
Historically, we've found a lot of good companies in the consumer staples. But as the economies have gotten stronger, we've reduced our exposure to consumer staples and invested more in financials and the materials space.
So as the cycle grows, is that what you say?
As it improves, yeah. Yes.
Okay. And when you look at the 9%, obviously it's not guaranteed. How have you, I guess, done over time? How does that work?
Pretty well. Other than 2008, we've done very well in terms of shooting for our aspirational return. Now the markets will be plus or minus around that return, but in terms of being able to capture the dividend, absolutely. In terms of being able to buy back stock and reduce debt, we've done that as well. The growth rate, we've actually done quite a bit better. In 2013, we earned 25%.
So it must take a lot of people, I would think, to go through the screen, then do the fundamental analysis, come through the risk strategy at the end.
We have a good team. We have 5 fundamental analysts. We have 3 people that do the quantitative research, and we have a risk management effort.
Okay. How long would you say it would take you to do one company?
It depends.
Yeah.
Some companies we know very well. It takes a couple, 3 days. Some companies can take 6 to 9 months.
All right. And what's your outlook right now?
Cautiously looking forward. The world economy looks to be a little bit better. The U.S. is certainly thinking about tapering its stimulus. Right now, cautiously looking forward.
All right. Well, thank you very much, Eric. I've been joined by Eric Sappenfield, who's Managing Director at Epic Investment Partners. Thanks for watching. Before you decide to invest, make sure you do your homework and ensure that the investment is aligned to who you are as an investor, including your asset allocation and your tolerance for risk.